You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, that theme music means it is time once again for Volatility Views, the premier program for volatility traders. My name is Mark Longo from the OptionsInsider.com, as well as from the ever-expanding, ever-exciting Options Insider Radio Network. 13 programs on said network for you guys to choose from. Where can you find all of those great programs, as well as all of the 100-plus archived episodes of Volatility Views? Well, surf on over to the mothership, theoptionsinsider.com. That's where you can find them all. Click on that radio tab. And we also tweaked the homepage there, so when you surf on over there, you'll see the player now reflects the most recent episode. You can click on it right there. So if you want to see whatever the most recent thing we've added to the network, could be the news show, could be Option Block, could be Volatility Views, could be whatever the newest and latest program du jour is that second, you can find it over there and stream it instantly as well. Of course, you can find them iTunes, Stitcher, AHA Mobile, and even our mobile app available for a variety of platforms, even the Amazon devices out there. We didn't forget about you guys. So no shortage of ways for you guys to enjoy all this 1,000+ hours of content we've put together for you here on the old network, as well as to interact with us. We love your questions, your comments, and you can do that. No shortage of ways on the website, the feedback form, email, questions at theoptionsinsider.com, Facebook or Twitter, twitter.com/options, facebook.com/theoptionsinsider. No shortage of ways. And if you can't find all that stuff, it's all just baked into the mobile app as well. So no shortage of ways for you guys to make your voices heard on the old program. And we love to hear from you. Speaking of hearing from people, I am also joined on the old Volatility Views panel by my usual volatility cohort, starting off with the man holding down the old option pit hot seat today. He is the rock lobster himself, Mr. Andrew Giovinazzi, beaming in from scenic and sunny Maine. Mr. Rock Lobster, welcome back to the program, sir.
It's a pleasure to be here, back to the great Vol Views program.
It is indeed a great program. It's one of my favorites. I hate to have favorites amongst the network because they're all like my children, but Vol Views is certainly up there. Let's just leave it like that. Even though it means I have to deal with this next guy on a weekly basis. Of course, I'm talking about the major domo of research and all things derivative over there at BGC Partners, Mr. Jared Woodard. Welcome back to the program, sir.
Oh, I'm so glad to be with you. I am the master of all things derivative, including things that are just copying and uninteresting in the other sense of derivative. I take credit for all of it, the good and the bad.
Yes. All things derivatives in all definitions of the term. They certainly amass. Look at Wikipedia for a derivative. Picture of Jared Woodard right there. And it says plagiarist in big words underneath. No, I'm just kidding, of course. That's the other definition of derivative, which we won't get into here on this program. All right. With the team all assembled, we're going to dive right on into the volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, welcome to the Volatility Review. In case you're joining us for the first time, as the name implies, this is the portion of the show where we dive into the week that was from a volatility trading and analysis perspective. And before we kick things off here, we are recording this on Friday, December 19th. For all of you playing the home game, you'll be listening to it on the following Monday or whenever you choose to tune in. We welcome you guys weeks, months, even years down the road. You're welcome to dive into our Volatility View archives and have at it. And as we are recording this, we are coming off the heels of some hot and heavy upside action in most of the major indices with consecutive days of significant rallies post-Fed, post-jobless claims numbers coming out a little bit better than expected, and just post a record exuberance for all things equity and index. And as we are recording today, that exuberance a little bit subdued, but still a rally nonetheless. Certainly in the technical definition, most of the major indices up about a third of a percentage point or so on the day. That includes good old VIX Cash, which is ticking up about 0.15 on the day or so today to 16.94. So pretty much upside wherever you're looking in the old markets today. But let's drill down a little bit into those different segments. Maybe perhaps since this is your first time on the show in a while, Mr. Rock Lobster, we'll start with you. What caught your eye in this week's volatility maelstrom?
We had a wild week in VIX, mostly because we had, as our old friend, Don Schlesinger would say, we had a lot of realized vol. When you have the market melting up, 2.25% yesterday?
About that.
We used to worry when it was down 2.25%. Like, wow, that's a big move down. I can't remember when we had a rally like that. So clearly, there was a lot of latent buy pressure, a lot of freak out about oil. I think even Mark had commented it took a while for equities and oil to become uncoupled, but it looks like it has to some extent. Mostly, I think, because the emerging markets and things like that, where there's some high yield debt out there, there's a lot of worry that low oil prices were going to create a wave of defaults or something like that. And at least up to now, it hasn't materialized. But that's enough to make volatility really fly. So we had, VIX Cash, I think was above 25 at one point. And it touched 16 and change yesterday for a brief second. The market started to rip, and even though vol was coming in, the curve was kind of moving up with the huge rally in the market, which kept VIX from really coming in. So you can't have volatility collapse too much when the market's rallying, 2% a day. It's not going to happen because VIX ultimately is trying to measure the movement either up or down. So we had a lot of it, and just crazy. Let's just call it. We had a lot of volatility. We had a lot of volatility, and even VVIX traded. I think, and Jared knows the exact numbers probably better than me, but I wouldn't be surprised if it was in the high of the year. We almost had a double in VIX too, at just crazy numbers. And what I find is interesting is how fast now volatility and the volatility products and even Volavol, how fast it spikes. I mean, literally it's like 3 days and boom, it's at, panic levels. So for all you trading volatility out there, I think the future is going to hold a whippier volatility trading patterns. And I think that's something you got to factor into, how solid your stomach is when you're selling stuff.
Yeah, and all the stories we're going to talk about today, of course, oil being a big one, but I think VVIX may be the kind of the untold, unheralded story. Just the vol of vol going on out there in the marketplace, and indeed in VIX right now, is just extraordinary. We saw it rally just over the past couple of weeks. It was trading down in the 80 range, 75 to 80 range just a couple of weeks ago, not even, like 10 days, and it gapped up to 140 just this past week, and now is kind of settling off the backside of that down to 103 today. So just crazy swings from a pure vol perspective. So if nothing else, that is interesting and worthy of note on today's show. And you mentioned there is some real vol creeping into the marketplace. We certainly saw that as well with these past day rallies. We keep saying on the show, people seem to forget it, but upside movements are still volatility. It's not just downside. I know we have this downside bias, you drop, vol increases, but upside moves, still volatility, and that's certainly playing out this week with the 10-day realized vol in the S&P now a whopping 22. So puts that VIX Cash of 17 in a little bit of perspective. You get out 30 days, a bit more level-headed of a 13, but still interesting stuff cooking out there. And surprisingly, perhaps, I think, given the fact that we've seen such a prolonged period of rallying out here in the S&P, usually that would probably be followed on the heels by some renewed interest in hedging these extended gains. We're not seeing that. The Skew Index out there, which of course measures that old 50 delta risk reversal out there in the S&P, still relatively on the lower end of that range that it's been over the past 3 to 6, pretty much all year. It's probably covering close to those ranges. It had a quick couple of gaps down into the 110 or so range when we had those crazy aberrations in October or so. But other than that, the kind of the lowest it got was in the probably 122, low 120s range, and we're hovering 126 right now. So clearly, despite the fact that we've been rally-ho all week, people aren't scrambling to lock in those gains, at least not yet, which is also pretty interesting stuff. But before I keep going, let me toss it over now to the maestro of all things derivative, Mr. Jared. A lot to chew on this week. What in particular caught your eye in the world of volatility?
Well, Andrew's right. I mean, VVIX, the vol of vol, made actually a highest level since 2010, since the spring of 2010. On this most recent move. So even though this is really important, because even though the market was, in terms of percentage movement in the S&P 500, this move in December was not especially remarkable. Even though the level of the VIX index did not climb as high in December as it did in October of this year. And a move into the mid-20s is, from a very long-term point of view, nothing remarkable, really, in VIX. So even despite all those ways in which, and we could add to that the fact that realized volatility in the S&P is still under 15% on a one-month basis. So despite all those extremely normal and basically kind of unremarkable things, what we did see was a massive surge in demand for VIX options, sufficient to cause that VVIX index to move, as you said, up to almost 140, which is a level that we hadn't seen in October. We didn't see it in at all last year or the year before that. Even in 2011, the worst point of that year, VVIX didn't spike that dramatically. And so we put out a report on Monday talking about this reactivity in the options market, noting some of these facts. And I think it's really important because it shows that investors have become more reactive, have kind of had itchy trigger fingers, and even the smallest perturbation in equity markets has been sufficient to send people, maybe not running for the hills in sufficient size to show up in skew indicators, as you said, Mark, but still sufficient, at least in terms of VIX options, to show up in those indicators, to show some really meaningful divergences between what's happening in a realized sense and what's being expected in a forward-looking implied sense. I think it's just really important, and I think this is something that we can look for into next year as people have positions that they need to get out of, and some of the liquidity issues that we've been kind of slowly getting into on the show. I think this is going to become a more and more important theme, and that these very small movements in the market, at least for now, this year, seem to be getting a response that's really far out of line with what we'd expect historically.
Yeah, that kind of surprised me, what you mentioned about the Skew Index, what we were talking about earlier. I kind of threw that in there as I was, we prepare for the show using a variety of different data that we review on a regular basis. And I kind of just like to throw the Skew Index in there every now and then. I know we've maligned it many times in the past as being kind of a weird product. It should be intraday, should be real time, all these other things, which it clearly isn't. So I was missing out on a lot of data from that perspective. But I was looking at it, and I just expected it to be substantially higher than it was. So, I mean, it's not cheap by any means. There is still clearly some hedging interest out there, but nowhere near perhaps what you might expect given everything else we've been seeing out there in the marketplace. So I mentioned VVIX being my surprise of the week, but perhaps I'll throw an honorable mention out there to the Skew Index as well, being perhaps not perhaps following along as you might expect. Mr. Andrew, I know you watched this a little bit, and you have some insight perhaps into what's cooking out there in the land of S&P Skew.
Well, I was going through with clients just this morning, just a little bit that, at the money. So you're a trader and you walk in yesterday, you're an index trader, and at the money volatility maybe was like 15.5. Actually, it was a little more, probably 17 and a half. And then if you look 40 handles up on your sheets, the volatility up there is only like 12 and a half, the way that, the skew curve works. So, and your question is, at the money, how much 12 and a half volatility do you want to sell when the market's just rallied 2%? It's kind of hard to get excited to do that. So I think part of the reason why the Skew Index is not really showing a huge divergence is because, like, all of a sudden there's a bid for the upside, and it makes the upside relative to the puts a little cheaper.
Yeah, upside crash, as we used to call them.
Yeah, exactly. And so at least until things settle down, we're not going to. I don't think we'll see. I don't think we'll see the VIX come down. I thought yesterday, early in the morning, I thought 16 would be the low for the week. We touched 16. I didn't get there, but close briefly. And it looks like right now, I don't think we're going to see the 16 handle today. I don't think we have a shot of it because they're just not marking the volatility down. Everybody's just scarred from the rip up, and that's essentially where we are. So that's where we find ourselves right now.
I love that you mentioned sheets.
Still, the vol's not going away.
I love that you reference sheets, sir. It just shows how we all date ourselves here on this show. Sheets.
Yes.
My sheets show 12% to the upside when I flip 8 pages back.
Exactly. I'm 20 cents over my sheets. Oh my gosh. I'm 50 cents over. I'm $1.
Crazy
These sheets
town.
are worthless.
Crazy town. Yes, the good old days of sheets. Not that long. Still some guys out there rocking sheets, which is terrifying, but c'est la vie. You can get away with it.
Are you guys talking about like fax machines and telegraphs? Is that the kind of era you're talking about now? I don't really know. I guess I'm just too...
Actually, pony whips and pony rides and buggy whips is what we're talking about here on the old program today. Yes.
These 30-year-old whippersnappers, I don't know what to do with them. These young guys.
All right, let's move on before we go down a crazy, crazy rabbit hole. If you're not familiar with what we're talking about, listeners, search for trading sheets. You'll have all sorts of fun, eye-opening experiences ahead of you. All right, moving on to, you mentioned the demand for VIX options driving the VVIX, and that certainly is what was moving the needle from a VVIX, from a vol perspective. Yet overall, it was kind of surprising how little action we saw in overall VIX options this week, given what everything else was cooking in the marketplace. We saw one day over 1 million contracts, substantially over 1.4 million. So that was certainly a very robust day. That was on the 16th. But aside from that, we didn't break the million any other days this week. We had an 850,000 contract day on Monday. So all heavy volume days, certainly. Nearly 1 million on the 17th, which was, of course, one of the gangbuster days there. And then, despite the fact that it was a banner move to the upside yesterday, only about 600,000 contracts yesterday, and on pace for about that same amount today, about 278,000 going up so far today. Of course, today being a little bit lighter day than the recent session. So certainly good volume and certainly numbers that any other product out there would kill for, perhaps maybe except for Apple and a few others, but not perhaps what you might expect given what we've seen in the underlying. You might expect 1.4 million for several days this week, if not more. So interesting stuff. It shows how our frame of reference has been so skewed, pun intended, by VIX's volume success that we expect now. Well north of 1 million on any given day. But looking at what we did see out there over the past week or so, was some hot trading out there, and a couple of particular strikes. The Jan 20s, once again, topping our list of the hot strikes, the strikes du jour, with a whopping 423,000 contracts open on that strike to really just dominate, run away with the number one spot on the list. The number two option on the list, I should say, is also a call. Much farther down the list, about 170,000 options fewer to be precise. It's the Jan 30s, a little bit more optimistic, though given what we saw this week, perhaps not outlandishly so, with about 250,000 or so contracts open. Then it drops off again substantially. Again, reflecting how we mentioned before, open interest right now, a little bit light out there in VIX land. In fact, I think we're pushing maybe record low levels or close to it for the year. We've got 137,000 open now, number 3 of the Jan 15 puts. And then it drops to around 100,000 for pretty much the rest of them, if not less. The Jan 22 calls, number 4, 117,000. Jan 21s, 109,000. 102,000 for the Jan 17s. And then the Jan 17 puts with 99,000. So that shows once you get post that settlement phase, that open interest really tends to fall off quite a bit. Total open interest here is only 4.29 million contracts, about 3 million on the calls, about 1.3 on the puts, which is fairly low. I believe the average for this year is well over 5 for the open interest levels out there in good old VIX options land. So that clearly reflecting, some of these positions going away through the expiration, but also some of these positions just people not as reestablishing that much going into the end of the year here, even with all these other things we've talked about here going on in the marketplace. And speaking of head scratchers, we have to just throw this into the mix. Before you look it up, maybe Andrew, I'll toss it to you. Don't look it up. Just if you had to guesstimate right now, how many contracts on average a day this week a product like VXST was doing, what would you guesstimate?
Oh, guesstimating VXST, I'm going to say 2,500 contracts per day. You
would think if any time was going to light up VXST, it would be this week, correct?
I would think this would be a pretty perky week for that product.
You would think. And so let's look at the chart here. On Monday, we kicked it off with 111 contracts. On Tuesday, it was 67. On Wednesday, a banner day for the market as a whole, 300. On yesterday, Thursday, which was the rockinest of rockin' days this week, 100 contracts. And today a whopping 451. So today being the most active, probably people just closing out. But yet another week of this product kind of just missing what's going on in the broader macro sense, what's going on in the mothership VIX, what's going on in the big S&P. None of that really translating into any appreciable activity or volume out here in VXST. I don't get it. If you're going to want a short-term VIX product, this is the week you're going to want it. And yet this thing some days will light it up, do 2,700, 3,000 contracts on days when the S&P doesn't move at all, when VIX isn't moving at all, when it hasn't moved. So this is still a bit of a head-scratcher. Jared, are you still watching VXST, or are you kind of just wash your hands of this product and say, it's going to do what it's going to do?
And if it ever does anything, I'll hear about it or get an alert or whatever. And I don't know. I feel like I've said everything I have to say about this product over the last year. We talked through the merits, we talked through the use cases, and sometimes there's just hopefully maybe we'll be wrong, but right now it just doesn't seem like there's a much of a natural constituency. The exchange either is unwilling or unable to do anything to change that, perhaps through no fault of their own at all. And there's a theory in academic finance. There's some good papers by Arrow and DeBrew, these economists from the middle of the 20th century, and they had this idea of the what's called Arrow-DeBrew complete markets, and it's actually a postulate that's used in some economic modeling that we're not going to talk about. But the idea of these complete markets is the notion of having liquid, tradable products for every conceivable state of the world. And sometimes I feel like, we can't trade futures on onions still. In trade, the political betting market is down for very obvious, interesting, relatively vanilla products that don't exist, that in some cases can't exist by legislation. At the same time, we have some relatively esoteric listed volatility products, which you and I and all the other guests on the show, I think, have weighed in as having some really interesting features to them. But when I think about some of these volatility products, and I think about the relatively vanilla derivatives products that don't exist, sometimes I feel like we're pushing in this tiny corner of what could be total Arrow-DeBrew complete markets, while ignoring just massive other opportunity areas for trading and risk management that just are being completely ignored.
Like onions, clearly. That's a huge marketplace that I can't believe we haven't gotten on the ball for that. I think we should have a whole onion volatility program going forward. What do you think, Jared? That's
well, we'd have to start lobbying Congress to change the law, and it'd be a lot of work.
The untapped potential of onions vol. Imagine the vol of onion volatility. My mind boggles at the thought.
I got to tell you, after a trip to Arthur Avenue from my family, whoa.
That would move the OVIX substantially in a single trading session there. So good stuff. Good stuff. Onions. I love it. But you're right. We have kind of belabored VXST. I wasn't planning on including it today, and yet talking about the myriad surprises that I saw this week, this was another one. I kind of, like Andrew, assumed this would be a rock'em sock'em week for a near-term volatility product, and yet not so much. So another pile of that under the many different surprises volatility held in store for us this week. Before we move on to the other segment, the commodity realm that is rocking and socking from a volatility perspective, Jared, I know you like to watch volatility beyond these fair shores as well, and keeping track on what's going on across the pond and in other areas of the world. So any international vol really register on your radar this week, Jared?
There's I think I mentioned this last week, and we just put out something on this late this week. But there's been a massive move in China between the what are called A shares, which are mainland listed equities, and the H shares traded in Hong Kong. The market in these two classes of shares has really diverged as a result of some enthusiasm on the part of investors in China, as well as a new connection between stock exchanges in the mainland and Hong Kong. And there's been a massive surge in the price of A shares in recent weeks. There aren't options traded in Shanghai and Shenzhen on those indexes, but there is an ETF that I think we spoke about last week. And so if you compare that with the vol in familiar products like FXI, the China FTSE 25 ETF, and other listed options on Chinese stocks, there's been some fairly interesting divergences there. There's also some economic data in China and other things that have been moving that market that are a little bit more vanilla and familiar. But I think this surge in popularity A shares, just the sentiment involved, has been really interesting to watch the last couple weeks.
Thank you for that, sir. You can always count on you for our glance beyond the borders here for what's cooking internationally from a vol perspective. And I know a lot of you out there are probably saying, get to oil. So we're getting there. Don't worry. This was, of course, yet another dramatic, crazy, throw in your own adjective for what we saw this week in oil. It's just been all sorts of really, really interesting movements. We saw a lot of that pronounced sell-off coming on again into the early part of the week, of course, ramping up some near-term vol, 2 to 3 month vol, depending on the product you were looking at, was hovering somewhere in the 38 to 50 range on a lot of these different products. We had guys like Putin coming out and saying we should get ready for $40 a barrel oil, perhaps, which is, of course, a crippling thing for the Russian economy. He said he's not sure if it'll stay at these levels or around 60 or perhaps even drop down to 40, which is surprising to hear him saying stuff like that. And yet, particularly in the early part of the sessions, we saw still a growing amount of bullish interest in oil across the board. We had mentioned this earlier this week on the option block program. It's worth mentioning again here how CFTC puts out their reports of the commitments of speculators and traders, and for their most recent data, which is a little bit dated, a couple of weeks now, ends at the period December 9th. Yeah, they saw money managers raising their net long positions in crude to these are the highest levels in about 2 months. WTI rising by about 7,000 long contracts. Short positions curtailing by about 8.5%. Brent, same thing, the highest level they saw in about 4 months for bullish bets, gapping up about 10%. Gasoline also gapping up 13% on terms of, these are the percentage of increase in bullish bets now, not the underlying. The underlying did the opposite, at least going into the early part of this week. In that same period that the CFTC was talking about, most of these long bets got clipped by at least 5%, if not more in some cases. So it wasn't perhaps the best time to be loading up on the bullish side of the crude fence. And then we also mentioned on this show last week, we're starting to see a little bit more bullish sentiment out there and things like the volatility skew on products across the board, Brent, WTI, etc. We had seen for a long time that call skew was pretty much flat. It was all puts all the time. Still heavy put premium out there now, but starting to see a little bit of that tail coming up on the call side. We saw that continued movement this week, and that seemed perhaps to be a little bit more savvy as now crude seems to have perhaps bounced off some of those lows, at least in the near term. I'll have to pull up for where we're trading here today, but crude has just been on this fantastic journey, and it's certainly been quite a bit to watch, quite a bit to chew from a overall underlying perspective, as well as certainly from a volatility perspective. Mr. Andrew, perhaps we'll start with you. I know you guys usually break it down in the USO perspective, but also in the old big CL. You guys have been known to dabble on occasion as well. So what do you make of this just ongoing saga that is crude oil these days?
I think the ongoing saga, I think we're finally seeing the first, is it almost a back-to-back day for crude being up, at least not down, if I'm not mistaken?
I believe so. I'll have to pull up our data for today, see exactly where we're trading, but I think you're correct.
I think we do have a little bit of a rally going on. So, yesterday it actually rallied a little bit. Today is a real rally. Obviously, that's good for, I think, what might be the probably buying opportunity of the decade for a lot of these oil services companies and things like that, especially companies that have tons of cash sitting on their books for the last 5 years. Wouldn't be surprised if you start seeing some more of those companies getting some bids perking up for these names. But volatility, I believe, hit probably 2-year highs, 3-year highs this week. Just kind of reminding me when gold fell apart, oil doing the same thing. It's actually kind of strange when the price of a certain commodity stays really high forever, generates a lot of people trying to go find more of it. And then all of a sudden it just falls apart for really no appreciable reason. Now, clearly it's a supply and demand thing, much like it must have been for gold when it was trading $1,800 an ounce and oil at $100 a barrel. I mean, you could almost, people at that point were probably starting to extract the petroleum out of the old paint in their house and could still make money selling oil. So, when the price of something stays very high, you get a lot of supply starting to come onto the market. And at some point, it all started to fall apart. Now, vol in here just extremely high. And I think at this level, I think this is probably one of the better times to start selling it. I don't know how many upside calls. I think you want to sell volatility that's of a little longer term and kind of be a little bit more balanced in it. But I doubt if we'll get a vol selling opportunity like this, for a while in the oil products.
Yeah, it certainly has been a premium harvester's good opportunity, provided you didn't get bit by some of that gamma. That's why you're saying, I'm sure, stick to the longer term stuff a little bit. But still interesting stuff out there. And you're right, it is rally ho again today. I'm looking at WTI right now. Most of the major futures out there up at least about 2.30, if not 2.5 on the day. So $2.50, I'm saying there, listeners. So most of the WTI hovering in the high 50s to right around the 60 handle there. So getting back to the 60 handle level, we'll see if crude and WTI can sustain that, or if Mr. Putin and his more dire pronouncement is perhaps correct, and this is just a brief flirtation to make some of these longs happy that have been loading up, and then we're going to dive back down to the downside. Only time will tell. Mr. Jared, what do you make of just the swirling chaos that is crude these days?
Well, there's a few interesting things going on. Even though we've had a little bit of stabilization in price terms, options traders don't seem to be relaxing at all. I was looking earlier this morning at option prices for WTI, for Brent options, even relatively medium-term stuff like 3 and 6 month maturity options are still priced in the top decile, or even in the case of like 3-month options, and it's still in the 99th percentile of values for the last 3 years. So I don't think options traders are starting to lower their bids or price things at a lower level of implied vol at all. And when you compare things across maturities, we see also term structures that are at the steepest levels. Backwardated obviously in all cases, but still at some of the steepest levels that we've seen during the sell-off. So even though the very rapid price declines might be over for now, the first month crude is back above $56. It doesn't seem like options markets are ready to take the foot off the gas pedal quite yet.
Yeah, it certainly seems that way from what we're seeing out there in the options realm as well. So it has been a very, very interesting stuff out here in crude. I think we have some relevant listener mail that ties into this. So I think without further ado, we're going to keep on rolling right on into the volatility voicemail segment.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, everybody. Welcome to the Volatility voicemail segment. Like the man said, this is the portion of the show that, quite frankly, I look forward to the most every week. No offense to Andrew, Jared, and Mark out there, but I love to hear what you guys have to say and the questions that are top of mind for you guys. As the man said, no shortage of ways for you guys to get in touch with us, including the website, the comments, the feedback forums, Twitter, Facebook. He neglected to mention Stock Twits earlier. We are Options Insider on Stock Twits as well. I know a lot of you like to float around out there as well, so no shortage of ways. You can even send us a letter by good old snail mail if you really feel up to it. So we'll take them in all shapes and sizes. Starting off here with a question from Vic Taylor. He writes, "What's the problem with OVX?" Well, that's interesting. We could spend a lot of time on what the problems with OVX are. But he goes on to write, "USO trades a ton of options, yet OVX averages 100 contracts on a good day. I'm looking for a good way to add some oil volatility to my portfolio. Since OVX is DOA, are there other dedicated oil volatility products out there that actually trade? Maybe something listed on the WTI or Brent contracts. Cool show. Love all the commodity focus you've added in recent months." Well, thank you, Vic. We certainly have added a lot more commodity focus recently because that's, quite frankly, where a lot of the vol is these days. You see products like VXST doing nothing, and we see products like oil lighting it up, so it makes sense to add oil in, and I'm sure if corn and others start lighting up as well, we will certainly add them to the rotation. We touch on gold every now and then because I know a lot of you like to look at that one as well, but we're very product agnostic here. If you have a product with some volatility, we'll probably talk about it. So if you have other ones you want us to talk about, let us know. We'd love to hear from you guys. If you guys out there aren't familiar with what he's talking about OVX. That is the crude oil VIX, essentially. It essentially measures, the name's a little bit of a misnomer because it really doesn't measure crude vol. It measures USO vol, which is, of course, that ETF that we've talked about on this show many times, maligned, perhaps unfairly. Jared came into his defense recently on the show, so there are some merits to USO. It's not completely useless. As long as you understand the weaknesses and the limitations of that product, I think you can be well served by it. It's certainly by no means a straight up spec on crude oil. So long as you don't go to it looking for that, then you won't be disappointed. And he's right. OVX does not trade. I'm looking at it right now. It is a listed product. It did a whopping 33 contracts today, and its ADV is about 106. So this is not a product that really trades out there at all. And, my inclination on these kind of things, if you're looking for volatility, is to go to the source. Go to the CL options. Go to the Brent. Go directly and get your vol that way. I've always found that to be my preferable choice. But maybe there's something out there that is equally suitable for him that we're not mentioning here on the show. So perhaps I'll toss it to you first, Andrew. I know you love to play around in the USO realm quite a bit. So are there other quality vol products that he's missing out on that he should be trading, or do you feel like me that he should just dive into the big futures options and be done with it?
One thing, we were looking at OVX this week with my clients, and we were just noticing the cash OVX price and where the options were actually marked relative to the futures. So similar to VIX, OVX is trading on the future. So some crazy disparity in those products. The markets were, I don't know, like $3 wide or something like that. So I was just pointing to people, it looked like an untradeable product, although I didn't follow up on the OVX settlement. Because, when the futures mark so low, depending on when the settlement is, sometimes the future has to climb back up to the cash price, as what happened with VIX this week. So as far as trading the vol, what you can do is just change the duration, So if you want to have a more vol-oriented trade, go a little farther back in time, maybe 3 months out. Reduce the gamma a little bit, and that will give you at least it'll give you probably more vol exposure than it'll give you gamma exposure, is the easiest thing I can think of. Because I don't think there are a whole lot of, or use the crude options, which we have clients that do. So, all you do is the easiest thing I can think of is just change the duration and stay away from the near-term stuff. Is really more of a gamma-oriented type trade. And that's where you get in trouble selling options more so than the long-term ones. because especially the swings have been relatively vicious in these products. And USO, at least from that point of view, it's a little more, if you have a lot of short gamma, you can maybe manage it by hedging the deltas if it's going in one direction. The USO is probably an easier product to trade like that than the crude oil futures, depending on the spreads and stuff like that.
Yeah, I'm looking here at OVX while we're talking, and it seems like the OVX is printing right now, the actual OVX index, right around a 55, 54.5. I don't have the futures up here, but they're probably, like you said, a little bit lower. But all the options in that range going out any number of months are all, it seems like about $1.20 or so wide, so fairly consistent from that perspective. I see a two lot of the March 65s that go up today for somewhat mid-market. They're about $1.90. These are a little bit tighter. $1.90 at 260. They went up about 228, 230. So maybe there's an opportunity for some mid-market trading, but I wouldn't really look to it here. This is the product you probably have to get close to the bid and close to the offer to get anything done out here because, like I said, it does about 100 contracts a day. So no one out there to really take the other side of these trades, unfortunately. Mr. Jared, do you watch OVX a lot, and what do you have to say here, if anything, to our friend Mr. Taylor?
I think if you imagine somebody who's looking for dinner, they want some fish. Fish and chips will get the job done, but they just got to insist on like wild caught Alaskan salmon. It's got to, and they want it certified, organic or whatever. And I think that's probably the situation for a lot of customers for a lot of these types of product choices. The fish and chips product, whether it's USO or if they have the capital and margin and needs for it, futures options on crude, or even like energy exposed stocks. I'll come back to that in a second. But there's a lot of these very liquid, very actively traded products that for many, many use cases of trading volatility, including very sophisticated views, these are all going to get the job done with lots of liquidity, relatively low transaction costs. I can't imagine, unless if you've got a really sophisticated view you're trying to express, OVX options could be the way to go. But I was looking at the screens on that just now, and for options in January and in March, even near the money strikes, they're all like $1 wide on the screen, which you could probably, let's say you assume you could do better working in order. You're still going to give up a lot of whatever edge you might have trying to get in and out of a position when a market is that wide. And as I say, unless you've got some nuanced view that requires the use of that, and you can't trade over the counter, then I would say stick with what works, and that's going to be USO options, crude oil futures, and then I'll come back to, as I said, there's a lot of stocks with very high correlations to crude oil, if you want that correlation, that are actually entities that a cash flow that produce a dividend yield that have some kind of value to them in a way that a physical commodity might or might not. And given the hits that a lot of these energy stocks have taken, I think we talked about this a week or two ago, there's some value cases that people are starting to put forward in some of these names that can give you potentially, even if you want to do a kind of a volatility-oriented trade, you can get some value underneath that to potentially provide some more support to the position. And again, I think you can do things there that are going to capture the same overall outlook, but with a lot more liquidity, a lot more precision than in some of these more unusual listed volatility products.
You can always count on Jared for a colorful food analogy. First it was onions, and now we have a delicious white fish and fish and chips. You're making me hungry here. It's around lunchtime here, so let's hold off on the food analogies for another 20 minutes until I can get something. But well done, as always, sir. You're right, there are a lot of different products to choose from in this universe, including delicious white fish, which you can also check out. Moving on to our next question from Jim Andrade, I believe you pronounced that. He writes, I know you've mentioned bullish risk reversals in CL as potential ways to play a bullish bet in crude. I believe he's referring to a conversation we had earlier this week on the option block program, actually, but it applies here as well. He goes on to write, I've been a little slow pulling the trigger. Is the environment still favorable for this type of trade? In CL, I'd consider Brent as well if that is more suitable. In case you can't tell, I'm a bit of an oil bull, but I've been waiting for the worm to turn. I think we may have finally hit that point. What about an iron fly where I buy at the money, sell 5% out of the money? Would that be preferable from a volatility skew perspective? Maybe I should throw in a time value of money question. Also, I like it when Jared gets worked up over futures term structure and roll yield. I like this question. This is the good one. So he's, of course, referring to when I was poking the bear last week with Jared, getting him wired up with that time value of money question. He mentions a lot of interesting stuff. We talked about this a little bit on the option block already earlier this week. So, Jared, since you're since you're mentioned directly in the question, I'll give you pride of place. What do you have to say to our friend here? Mr. Andre wants to know about risk reversals and vol skew out there in WTI, as well as he enjoys the fact that you get worked up on the show.
Yeah, what a jerk. I mean, I can't believe it. No. Yeah, I like, that's a great question, actually. The case is that in WTI, 25 delta risk reversal is still pretty low, not at the lowest level of October, but just barely above the levels from earlier in December. So if you're interested in that sort of thing, I don't think that trade's over. The normal, going back to the beginning of the year, just kind of eyeballing a chart, 25 delta risk reversal usually seems like it's priced around -1 or maybe -2. And on a Bloomberg right now, it's quoted at -5. So that gives you a sense of things. I pulled up 10 delta just for the fun of it, and that's even more extreme, still around -10 or so. So it looks like there's quite a lot of, I mean, that would make sense, right? Because we're just talking about how the levels of implied vol overall are still very high, despite some stability in crude prices. And so it makes sense that we would see the cost and risk reversals not to have unwound recent moves. So hopefully that's good news for the listener. Was that all of the question? Sorry.
He asked you also about iron flies, buying at the money, sell about 5% out of the money. So that's kind of what you were referring to earlier.
Yeah, that's about as detailed as I'm going to get anyway.
Don't want to get you in trouble over here on the old program. Andrew, this kind of dovetails on what we were talking about earlier this week on the Option Block program. Listeners, if you don't tune into that program, I encourage you to do so as well. We were discussing how favorable some of these setups were in a last couple of weeks, particularly as we talked about that ridiculous put premium you were getting, of course, to write that put, and then, of course, the upside being relatively cheap. It was pretty favorable, provided you could deal with the gamma and hedge away with it. You, of course, had some gamma risk in the near term if you were trading on that near term stuff, because oil has been moving pretty aggressively now, but now it seems to be shaping up a little bit. And Jared's right, that trade is still out there, perhaps not as favorable as it once was. The premiums come in a little bit. The calls are a little bit more expensive now, so it's not as ideal as it once was, but it still is an interesting way if you're looking for a way to, like you say, you're an oil buff or an oil bull and you think it's going to rally. That's a better way than just coming up and loading up on at the money, certainly. From an overall nuanced perspective. Anything to add here, Mr. Rock Lobster?
I think mostly, we have, when you're trading a risk reversal, you have to be prepared for the worst. So, just remember, oil has stopped dropping right now. It's getting a little bit of a bounce, which is fine. But if you're putting that position on and you're short the put, you could still be in for kind of a nasty ride. I like the trade as a bounce. I think you're getting a good risk reward scenario for it. But just make sure if you have a target price, what your risk reversal is really going to be worth. Sometimes it might just be easier to sell the out of the money puts, because normally on a risk reversal, even with the volatility so high, you need a pretty good bounce to make some money on it. And check the delta of the trade. What's a reasonable delta? I mean, if you go far enough out of the money on the put and call, I mean, you have a risk reversal at a 10 delta, you only get 10 cents per dollar in the underlying. So you have to be thinking about, what if you're going to the 25 delta, then you get 25 cents per, and you get 50 if you get 25 for the call and 25 for the put. So, just add up the deltas and make sure you're going to get paid for the thing if you get the move you want. That's all I would say there.
Spoken like the degenerate premium seller we know you to be, sir. Just sell the put. Who wants to buy that call? Whoa, that's crazy talk. I know you cling.
Don would love me.
Don would be very excited right now hearing that. I'm sure he will be very happy when he hears the archive. Of course, I'm just kidding, listeners. Andrew's been known to buy an option or two in his day, though he does like to. He guards his premium judiciously, which is a good thing to do. Speaking of perhaps guarding premium or not, really quickly, we have a quick comment here coming in. We'll wrap up the listener mail with this one. I believe this is from Mark Brandt. He writes, some of New Friday Weekly SPY and VXX at the money calls is lower than each's range, so I bought both. So there we go, listeners. There's one other viewpoint to add to the mix. Maybe perhaps this week's range is maybe a little bit of an outlier, so maybe you don't want to use that exactly. But still, hey, good luck to you, sir. Hopefully that trade works out for you. A fun little silly one to add to close out the old listener mail segment as we keep on rolling right on into our final segment. Yes, it's time to peer into the crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, everybody. As the name implies, this is the portion of the show where we prognosticate recklessly and indeed just wildly, without any abandon, without any heed to things like compliance or just due diligence. We really just go outside the bounds of propriety here on this segment. So buckle in if you haven't already, listeners, because it's about to get crazy. And when you're thinking crazy, when you're thinking outside the bounds of law and normal human decency, you of course think Mr. Jared Woodard from BGC Partners. So Jared, start us off, sir. What do you have for us in the crystal ball?
I think we're going to get quiet holiday week that everyone, the week that everyone was would be typical of December as a whole. Everyone was closing their books, putting things to bed for the year. This oil rout, I think, generated all this repositioning and hedging, and I think now that people have adjusted quite a bit, I'd be surprised if over the holiday week and into the new year we don't have some actual quiet holiday trading. That's my expectation.
Yeah, we all kind of certainly came into this month expecting, eggnog and stockings and not a heck of a lot from a market perspective. And you're right, oil and certainly a few other factors really combined to shake us loose of that view. So perhaps in the week to come, we will get what everyone finally expected. Mr. Andrew, do you hold that notion as well? Or are you taking the counterpoint, the Jane, you ignorant slut point, and saying we're rocking and rolling all next week too?
I would like, last week I thought we could see a little more volatility. I didn't think it was over, mostly because, again, channeling Don, we had a lot of realized vol. I want to say I think vol should go down, but I don't know. This is one of those times I'm kind of agnostic to volatility right now. I don't have any large short vol positions on anymore.
Sorry, Andrew, did you say that you're agnostic?
Agnostic.
Like eggnog, right?
Like agnostic, meaning I want to drink spiked egg.
It all comes back to food with Jared on this show this week. You must have missed lunch, sir.
That might be the funniest thing Jared ever said. Andrew, you're agnostic.
Thanks.
To vol. So I'm actually a little, mostly because we're just ripping. So it's like, and again, we're up almost 0.5% today. It feels like, we've bought the dividend back in the SPY already. And I think until, at least from a trade point of view, you're not really going to see that vol come in until the market stops going up, I think. And that's essentially what my viewpoint is. Until we stop moving up, vol's not going to, I think we're not going to get the drift down in vol that we're looking for. Futures, I believe, are still, last time I checked, we're still trading right at around cash over the holidays. When was the last time that happened? So there's too many, I'm just going to say the vol indicators I look at, there's too many conflicting signals. If you put a gun to my head, vol probably will be in the lower next week. But as of right now, I'd say there's nothing to keep it from sort of driving a little higher right now. Gotta say.
I don't know about you guys, but I need to go have some whitefish with onions and perhaps some eggnog on the side. So it's time to wrap up this puppy. But before we go, as always, let me check in with each of my cohorts here on the old Volatility Views panel. See what they have cooking that may interest you, aside from their delicious holiday dishes, as Jared has repeatedly referenced throughout the show. So, Jared, we'll start with you. What's coming down the pike in this final couple of weeks here of the year at BGC Partners?
Well, we this week was actually pretty busy. We put out a broad market piece on Monday on some of these volatility indicators that we've been talking about. On Friday this week, we put out a big piece on China, and our 2015 outlook is coming in the next week, maybe two.
Good stuff. Looking forward to that. See how reckless and wild you get, because I know how crazy you get on this show, how reckless and wild you get in that 2015 outlook. Should be good stuff. Bone chilling, perhaps. So stay tuned if you're a client of BGC Partners. Some good stuff coming down the way for you guys. Speaking of clients, Mr. Andrew, what's in store for the clients and mentees and perhaps potential new ones lurking in the audience over there at Option Pit?
Well, in 2015, we're going to start launching we're going to launch shorter term advanced trading seminars on vol products, using portfolio margin, diagonal spreads and stuff like that. That will probably be a lot different from sort of the ordinary stuff that's out there. Mostly a lot of the strategies that we use daily, but trying to target advanced traders in general. And we'll also have basic trading courses similar to our boot camp. We've gotten a huge response on all that stuff. People want to see more of it, so we're going to give them to them. So be looking for those new classes coming out basically monthly next year.
So you're following the trend of the broad options market and going short durations, what you're saying?
Something like that, yes. Well, we know how well that's working for VXST right now.
Yes, that's true. That's the one outlier that tends to prove the rule. And I'm still waiting for my copyright infringement check on the old options bootcamp theme because, of course, we've had that show for many years. But I digress. That's a conversation.
That check is coming.
A conversation for another day. And on behalf of Andrew and Jared, and of course myself, I want to thank all of you out there in the listening audience for downloading and streaming and putting up with our food-related banter today. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.